After a week of choppy action at the highs, bearish pressure is back in the gold market. What's been driving the recent moves, and are we more likely to see a continuation or a reversal in the short term? All that and more in this week's episode of As Good as Gold. Greetings, fellow traders. I'm Dylan, Research Strategies at Pepperstone, presenting the latest weekly update on As Good as Gold. So after surging to a record high of $3,500, gold has pulled back, with bears now taking the driver's seat. A combination of easing tariff tensions, reduced recession bets in the US, and the Fed's wait-and-see stance on interest rates are all putting pressure on gold's rally. Friday's nonfarm payrolls report could shake things up again. So now, looking at the gold against US dollar daily chart, gold spent much of last week stuck in a tight range between $32.60 and $33.80 as bulls and bears fought for control. But on Thursday, selling pressure broke the deadlock, dragging prices below the lower bound of that range. Gold is now struggling near the 20-day moving average, and if the sell-off continues, the 61.8% Fibonacci retracement of the rally since early April, around $31.62, which also aligns with the April 3rd high, could act as a support. On the flip side, if bulls step back in and drag prices back into the range, $33.80 remains the key resistance level to watch for signs of a renewed uptrend. Well, in my view, this pullback in gold reflects a broader shift in market sentiment. In the short term, three factors are driving gold's direction: US tariff talks, a reassessment of the US economic outlook, and the Fed's policy path. As trade tensions ease, especially with Trump dialing down the rhetoric on China and Beijing signaling a willingness to negotiate as well, the sell America narrative is losing steam. That's cooled safe haven demand, dragging on gold. While the talks may progress slowly, market fears around tariffs has eased for now. Sentiment has shifted from panic selling to cautious optimism, and that shift is weighing on gold prices. Meanwhile, despite some weak consumer confidence numbers, better than expected prints in durable goods orders, thanks largely to transport and defense though, and US ISM manufacturing PMI have helped calm recession fears. Another headwind for gold, obviously. So together, these shifts have pulled the gold narrative away from credit risk a bit and back towards rate expectations. Even though Trump has made it clear he won't remove Powell, preserving the Fed's independence, the rate cut outlook remains quite cloudy, I would say. March core PCE slowed on a year-on-year basis, supporting the case for rate cuts, but it doesn't yet reflect the impact of tariffs. And Q1 GDP turning negative was largely driven by a surge in imports ahead of expected tariffs. So both inflation and growth data are currently distorted, offering little clarity for the Fed's next move. At the same time, tariffs may have asymmetric effects on inflation growth. Prices tend to spike quickly, but the drag on economy shows up more gradually. This mismatch could keep the Fed in wait-and-see mode, delaying cuts and keeping gold's upside in the near term. So all in all, with trade tensions easing, recession risk fading, and the Fed sitting on its hand, gold may remain under pressure in the short term. That said, on a broader time frame, underlying drivers like continuous central bank gold purchases, persistent geopolitical uncertainty, ballooning US debt, and Trump's unpredictable tariff stance should continue to provide a floor for prices. Of course, all eyes are now on today's nonfarm payrolls report. The market consensus is for 130,000 jobs added in April, down sharply from March 2028,000, with the unemployment rate steady at 4.2%. Given that a soft job print is already priced in, a truly disappointing number, say job growth below 80,000 and a clear rise in the unemployment rate, could reignite recession fears. In that case, market may bring forward expectations for a June Fed cut, potentially giving gold another shot at fresh highs. Otherwise, gold may need a new catalyst to kickstart the next leg up. So that's pretty much all for this week. If this video was helpful, don't forget to subscribe, like, and spread the love. If you have any ideas on how the upcoming data might impact gold trading, drop a comment below and let's chat about it. Stay tuned with Pepperstone for more insights and updates. And until then, happy trading!